Equity Management Academy. September 28, 2021. Gold. The VCPMI 360-day cyclical S&D annual report for 2021-2022. Summary. The annual trend momentum of 1794 is bearish. The VCPMI of 1840 is bearish price momentum. A close above 1840 stop negates this bullishness neutral. If short, take profits 1572 to 1409. If long, take profits 2003 to 2271. Trading instructions. Yearly trend momentum. 1794. Bearish. The gold futures contract closed at 1734. The market closing below the 18 SMA of 1794 is confirmation that the trend momentum is bearish. A close above the yearly 9 SMA would negate the bullish long-term trend to neutral. Yearly price momentum. 1840. Bearish. With the market closing below the VC yearly price momentum indicator of 1842, it confirms that the price momentum is bearish. A close above the VC yearly would negate the bullish signal to neutral. Yearly price indicator. Exit, longs. Sell 1. 2003. Sell 2. 2271. Exit, shorts. Buy 1, 1572. Buy 2. 1409. Look to take profits if short on corrections at the 1572 to 1409 levels and go long on a yearly reversal stop. If long, use the 1409 level as a yearly stop close only, and good till cancelled order. Look to take profits on longs, as we reach the 2003 to 2271 levels during the year.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes.
Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room here, live streaming in YouTube. I wanted to share this 360-day cycle report that just came out as of September 28th, 2021, as it relates to the next 360-day cycle for 2022. So let's take a look and see what the markets are indicating for us here. We have a lot of green on the screen, particularly on digital currencies here, that the Bitcoin is up about 10%. We have seen a reversion all the way from the average price of about 42,000. We have an interesting situation here between silver and gold in that silver is up about 33 cents, while the gold market is down about 250. So I think what's happening here is that we're getting an adjustment on the gold and silver ratio, which was trading roughly, I think, at about 88, I believe, over the last few days. So we've seen the silver market appreciate about 35 cents to gold, which is down about $1.40. The metals markets are obviously into a completion of a seasonal low, cycle low that essentially is looking to put the yearly lows in place. And basically, the fundamentals that we're dealing with right now, in my opinion, have basically not affected at all in terms of the gold price. The gold price is trading on purely technicals, not fundamentals. we have a lot of issues that need to be addressed. A lot of issues on the table. You have a debt ceiling looming, pending. A crisis that could develop, and we bought some time until about, I think, December. But there are a lot of other issues that are indicating that consumer spending is running at very, very high levels. Inflation is running at much higher levels. The supply chain is being affected by a delay of basically cargo ships not delivering the goods, and they're stuck in ports around the world. It's a complete mess. On top of what appears to be is beginning to build price inflation. And so for the time being, I think the markets are beginning to feel that we might be running into some kind of a supply squeeze situation, in particular as we move into the holiday period. The consumer is flooded with cash. A lot of money is in the market, and it's looking to buy things. But we're dealing with this dilemma now that we basically are bottlenecked in terms of the availability of supply. So it's kind of stagflation situation that we seem to be dealing with right now, and it remains to be seen how long it's going to take before this situation resolves itself. But in the meantime, the talk of tapering is on the table, off the table, on the table, off the table, depending upon how the market reacts, you might say, one day or another. And I think it's particularly very, very confusing when you try to use these fundamentals to, put on a particular strategy. Now, leaving the fundamentals aside, coming back here to the gold market from a technical point of view, using the variable changing price momentum indicator, it has anticipated that the 28th of September, we began the next 360-day cycle. And this cycle should take us all the way into 2021. And obviously, if we take a look at the cycle, what it's saying here in terms of the prices, it looks like we are looking at the average price to be 1840. The 9-month moving average is 1794. Okay, and so the market is trading below the 1794 moving average, and therefore it's coming into this period with a bearish trend momentum. This is the average price that gives us basically the trend momentum. And so if the market closes below that price, then it is a bearish momentum, trend momentum. The next indicator that we use basically is the VCPMI, or the variable changing price momentum indicator. And that indicator is basically the average price that tells us the price momentum. And the price momentum is the velocity of price in relation to the big trend, which is the 1794. So we have the 9-month moving average bearish. We have the VCPMI, or the variable changing price momentum indicator, bearish, and therefore the market has activated the targets below, which are 1572 to 1409. Now, this is the mathematical range that on the other side of the coin here, of the reversion to the mean, if we get through the 1840, is the critical level to watch that will shift the price momentum bullish, or will shift the price energy bullish, and it would automatically activate the targets of 2003 to 2271 for the next 360-day cycle. Now, this gives us a pretty good picture of the annual indicator, and so in order for us to use this in terms of trading and how we trade it, we take a look at the short-term situation in the market, and we compare and see what is the short-term cycles unfolding in relation to the long-term cycles. Because the short-term cycles, the short-term trends, or the daily trend, you might say, if we specifically talk about a day trading structure, for day trading purposes, obviously the signals for the day usually not only give you the opportunity to establish a position, but bear with me 1 second here. Let me adjust this. Okay, I think we're back here. Excuse me. It gives us an idea of the turning points on the shorter end of the market, and that's what we want to see. As the market turns short term from the actually 15-minute bar, which is the time frame that we use to execute trades, it begins to form a structure where it tells you where the supply and demand extremes are. And in this case, for example, silver coming down at 21.41 gave us a pretty good idea that this area was accumulation of supply. And we recommended, if you take a look at my videos yesterday or the last few weeks, I've been suggesting that this area is in blue in particular. And when it is in blue, what it recommends is for you to accumulate supply. And how you accumulate is up to you as a self-directed trader, whether you use stocks, futures, options, ETFs, or a combination of all of them. What I'm sharing here with you is the instrument that I use to day trade for myself on behalf of my trader subscribers in my private trading room, which essentially is as a GPS. It is not a guarantee science, so to speak, but it is a mathematical probability model that identifies the extreme levels, above or below, of the supply and demand. And when I come into day trade, I look for the extremes of those levels, which give me a high probability model, a high probability signal that I can make an educated guess and decide whether I want to take that risk and how I want to measure that risk. The one thing that you don't want to do is when you're entering into a position, you have to decide whether you want to enter a position long-term or a position short-term. You got to define the type of trading that you're doing, and it's very scientifically. You don't want to go into a situation that you buy long-term, and like most of the time, it does decline in value, and all of a sudden you feel that you have to sell. Well, if you're buying long-term, then you want to hold on to long-term. Commit the amount of money that you can afford to lose, and position yourself and allow for the market to do what it's got to do. And if you're buying long-term, unfortunately, sometimes we got to take the drawdowns in the market until the market reverses. But in the meantime, I use the short-term end of the market to generate liquidity. When I generate liquidity short-term, I take that money and I continue to buy long-term. I continue to buy insurance long-term. We're at a point in this market here where we got to put aside all the shenanigans that are going on, and we're going to be dealing with the actual market, which is going to be basically weighing out all of this economic landscape, which is in complete chaos. Nothing really makes any more sense when you take a look at the old fiat dollar valuations. When you take into account the old formulas that we use in order to manage, in order to identify, in order to create any probability model. Those models do not apply. Technology is moving at a rate that is unprecedented. AI is coming in at a rate that, again, is changing the complexion of everything that we do as we knew it. And we have to adjust to this technology or you're going to be left behind. We're moving into a digital world. And we're pretty much taking the physical world now and digitizing it. And so that we are going to have, pretty much a hologram in front of us that gives us an idea of the digital world that is duplicate of the physical world, that will give us the ability to manage it from an AI point of view, from an artificial intelligence point of view. And we're taking that quantum analysis, so to speak, and applying it to the markets. Very excited about the prospects in terms of what we can see here over the next couple of years. And I think in particular, what you're looking at is Bitcoin, for example, which is a digital asset. It is moving at a higher level of volatility than any other market that I have experienced in close to 30 plus years in the business. And I have seen incredible changes in technology. And since I was on the floor, from being on the floor and just looking at the boards and using manual charts and all that, to where we are right now is an incredible transformation that I think is very positive. You can calculate analysis instantly. You can get results instantly. And, in terms of the mathematics behind the virtual world, or the physical world, obviously, is the transparency that we see in the technical world. The markets are a matrix. Each of this instrument is a matrix in itself with its own criteria. And so we do quantum analysis on each of the markets using a specific formula that quantifies for us the average price, and then it gives us an extreme above that average price with a mathematical probability that tells us the price has reached the sell one level. And this is the weekly analysis. When the price reaches this level, you're entering a high probability now model that you may find supply here all the way up to 51,222 for Bitcoin. And so if you're long Bitcoin and you have some profits built in here, this is a good time to be managing those profits. Not necessarily liquidating them, but synthesizing them, locking in the profit without eliminating the upside potential. There are many ways that you can do that according to your profile. But coming back here to this indicator as a GPS, this guides you basically where we can experience the high level of demand or supply come into the market. So, in other words, in using conventional technical analysis, it's supporting resistance. But it goes a little beyond that. It goes a little beyond pivot points. These pivot points are highlighted with a mathematical probability that activates a trigger point. And that's what we watch. There's a specific methodology that we follow that you can learn. It's simple. It's not as complicated as most people think it is, but it's just a concept that is a mathematical probability model, and we try to adhere to its model as much as we can when we are self-directing our trading. And so, but in terms of what this does clearly here, it tells us here now that the market is in an area again where it has reached the weekly targets. We traded above the daily of 44,570 at about 12:15 a.m. and then just exploded above. When the price on the daily reaches above the sell 2 level, the program goes neutral, the system goes neutral, and then it focuses on the next target, which is the weekly target. And so this is when I begin to identify the early stages or the earliest turning point of a cycle, which usually begins in its infancy stages, from a 5-minute, 10-minute, and you can use any time frame that, works for you. We particularly, or one of the functions of the algorithm is that we use the 15-minute bar to execute on the close conservatively or the opening aggressively. And we adhere to those principles. When the price reaches these levels, depending upon your profile, again, you can manage your position intelligently. Let's go back here to silver. Continues to trade in between the sell 1 daily of 22.44. It's completed the target again here, like the Bitcoin, so expect a little bit of volatility in trading to take place. It has met also the weekly target of 22.53. GBTC, which is the Grayscale Bitcoin Investment Trust, you saw sharply higher opening here, and it met the target, the weekly target of 37.47. So it is the positions that we have are completing the targets as expected. And as we complete the targets and the markets trade above, let's say, the sell 2, daily, weekly, or monthly, then it begins to form the support for the next higher fractal in price. I happen to have this here with me that essentially is the physics of the algorithm, in that you see here, if you push the price all the way down to the extreme levels below the mean, what happens is the energy gravitates back to the mean. The same thing if you push the prices up to an extreme above the mean, prices will gravitate down back to the mean. This is the physics behind the quantitative analysis that we do and the model that we use. And, excuse me, once that average price is identified, then you can extrapolate the levels of the extreme above or the extreme below, and we incorporate into that formulas that gives us the mathematical probabilities. So it is a GPS that we use for the benefit of self-directed traders like myself, like you, and students that want to learn a Very methodical, systematic way of approaching the market without trading with emotion. I have reversed engineered basically the algorithm that was written in TradeStation in C++, easy language, so that, again, for the benefit of self-directed individuals that are serious about trading, can take a look and see how this works, and it may be something that potentially can change your life, potentially can change the way you look at things or the way you trade. It is not the common denominator. It doesn't use the average mentality, you might say, out there. It's more of a contrarian indicator that tells you the extremes levels above or below the mean. We seem to have unfolded into a bullish trend momentum here for the silver market. The silver is leading the way in the precious metals. And even though we have a little bit of lagging, you might say, on some of the gold mining shares, I think that the path of least resistance is to the upside. And I do believe that we're going to be adjusting here as we move into the middle of the month, the middle of October. It's going to be an interesting month, as there are many things on the table here that fundamentally can change and shape the markets. But you want to pay attention very closely now as we move into the end of the year to precious metals, gold and silver in particular, for a potential reversion unfolding, which could be of a great magnitude as we move into the end of the year. And some of the indications potentially are telling us that once we establish the bottom, the annual bottom here, we could be looking at about a 20% rally into the end of the year or the first quarter of 2022. Thank you, everybody, once again, for the opportunity to share this incredible information with you, and I look forward to seeing you next time. Until next time, my friends, you take care, be well. Talk to you soon.